So most of the questions we received were about your investments, how to navigate the market, which of course has already caused much damage to financial goals and many people's dreams. I'm lucky enough, though, to have two of the best investment strategists to help us kick off the show. Joining me now, Advisor Group Chief Market Strategist Phil Blancato and Lafler Tengler CEO and CIO Nancy Tengler. And I want to just jump straight into the questions. I think the first question is from Suzanne Howard.
Yes. My question is, if you can tell us if you think we've hit the bottom of the market yet.
All right, tell you what. I'll start with you, Phil, and then you, Nancy.
Okay.
Yes, okay. Good wishful thinking.
Yeah, sure, but no, we're on our way up. You know, traditionally, markets need to really wash out completely for us to see a liftoff. This time it's a little different. The key thing that has to change is inflation. In order for that inflation, the key thing that has to stop is the Federal Reserve raising rates. In order for them to stop, we need oil prices to come back down below $80 a barrel. Until you see oil correct and come back down, the Fed won't put on the brakes, and for that reason, we're not quite there yet. However, I don't think we're far away. I think we're at the mid-September, early October. It's a chance for the market really to lift off. I actually think the Fed's going to pause in that September, October time period or lower their forecast, and that's where your opportunity to go much higher in the market, assuming oil comes back down below $80 a barrel.
Nancy?
I think you're right. I don't think, however, that oil is going to come back down below $80 a barrel. But I do think now's a great time to be adding risk back into your portfolio. And we've seen the NASDAQ come back. I don't think it's over yet. But these do take time. These corrections take time, as Phil described. But we are in a midterm election year. And as independent and non-political as the Fed is, they're very political. And so I think you'll see a pause, and I think that will be a chance to add more. But I'd be adding now.
Yeah, some think that the Fed cost Bush Sr. His job. At least that's what one of the entities that he blamed it on. I want to go to David next because he sent us in his question, quote, "Are we now rotating away from consumer discretionary because of inflation fears?" This is a very timely question because the market got hit a little bit today. It's actually shown some resolve. Many might know Walmart warned for the second time. And essentially, it's an interesting warning. It's not that people don't have money to spend. It's just that the things, the essentials that they need cost so much that they can't buy anything else. So maybe that's why we're not free falling. Nancy, are you surprised? Honestly, when I saw the news initially, I wouldn't have been surprised to see the markets down 1.5%, 2%. They're actually showing a lot of resolve today.
Yeah, I think that's because we've seen a lot of warnings, and for the reason you described, we've been adding back to consumer discretionary names in the past 6 weeks. So I think this is a fair time. You're never going to hit the bottom. Being an investor is like being in a perpetual state of dissatisfaction. You buy it and it goes down, you bought too much, and you buy it and it goes up, you didn't buy enough. So you just want to be disciplined and dollar cost average your way in. I think there's a lot of consumer discretionary stocks that are going to look really good coming out the other side.
I was checking out Lulu before I came down.
We just bought it.
Really, yeah. It looks like a screaming buy to me. Although I will warn, if a company says we ain't going to make money for a long time, I wouldn't necessarily rush in to buy the stock. All right, let's go to Sandra with an email question. Should people that are already retired move their IRAs into cash until this roller coaster ride is over? How can the people that are still working, protecting their 401ks, can they move some of their money into cash and then continue to contribute along the way with their employers contributing? It's a sort of a complicated question, but Phil, do you think people should get that cute with their retirement account?
They should not. First off, your best vehicle you can save in is your 401k. When your company's supplementing your income by giving you that match, you always take advantage of it. Second off, it doesn't matter a degree to how long you have to retirement. If your retirement time frame is 1 or 2 years, you can get more conservative in your investments. But assuming you're still working and have a lengthier period of time, more so than 5 years, and stocks are the best ingredient in a portfolio when you're in an inflationary period. When things inflate, generally the stock market does too, and finally stocks are cheaper. To your point, prices are now really better than they've been in quite a while. So for that reason, you should be a buyer of stock in your 401k. Cash is never a winning investment. It doesn't work. Think of it this way, Charles. Bear markets last around 11 months. Bull markets last around an average of 4 years.
Right. Yeah.
Average return after a bear market is 24%. Right. If we're at the end of a bear market, then it's your chance to buy stock.
And folks, put yourself out there. If you can go in the future 10, 20 years out and then look backwards, do you think you'll be saying, gosh, I wish I bought, I wish I held? The answer probably is 99.9% yes, you wish you bought and held. Yeah. All right, I want to go to Elvira in the audience with a question. Elvira?
Hi, Charles.
Hi.
Based
you picked the right color. You had simpatico.
Thank you. We have good taste.
Thank
you. Based on the current economic situation, where do you think a good place would be to invest $100,000 for the next year post-tax.
Nancy, let me start with you on that.
Are you selling it in a year?
No, it's for future educational purposes
Okay.
for children.
I think you want to be exposed to the dividend growers. This is a good time because in our portfolio, for example, dividend growth is about 9%. That used to be way ahead of inflation, not so much now. But that's a great way to get paid to wait for the underlying stock to outperform. So there's plenty of ways you can do that. There's great ETFs, dividend aristocrats, all sorts of places, or individual securities. Pick 10 of your favorite names and that's another way to do it.
You know, one thing I love about Nancy and Phil, and the reason I ask them to do this is they always come on every show with specific strategies, right? It's just not sort of the, plain vanilla kind of stuff that doesn't help you. And Phil always has something elaborate. So what would your answer be to Elvira on that one?
What's your favorite toothpaste brand? I bet it's made by Procter & Gamble. Procter & Gamble traditionally pays a wonderful dividend. Buy the stock, set it, forget it, be paid to wait around. That stems volatility because you're earning a big dividend. And then on the other side of this, maybe 6-9 months from now, when growth comes back in favor, we start to grow as an economy again, you can think about a different allocation. But for now, own a Procter & Gamble, own names that you go to. What's your favorite hotel chain that pays a nice dividend? Buy those dividend payers, go out and own them, be paid to wait around, and you'll have great success.
All right, I want to go to Robert M. He actually sent us in a question. What is the best long-term dividend stock? Well, Phil just gave us an answer. You have a favorite dividend stock here?
I do, but I'm a portfolio manager, so I have two.
Okay.
She's diversified.
We
She's
always
smart.
have to hedge. I think this is an interesting time to buy Target. They just grew it 20%, and I think you want to use weakness to add to Apple. Not a huge dividend, but a huge dividend grower. So those are two names.
Are you a fan of dividend aristocrats? And
Yes.
folks, these are companies that have hiked their dividend yield every single year for at least 25 years. I think it's a wonderful list to begin with. I would go through them with a fine comb because sometimes they'll hike it by a penny, right, just to stay on the list. So I'm like, okay, technically you're an aristocrat, but, that's more like a pauper move. But does it mean something when a company's that committed to sharing cash with their...
Absolutely. My partner and I wrote a book on this in the 1980s called Relative Dividend Yield. Don't buy it. I think it's probably out of print. But what we said was, and it's true, that management set the dividend policy based on long-term sustainable earnings power. So they don't want to cut the dividend. And if they have the conviction to raise it, they're better at that than Wall Street. Wall Street tends to be wrong about 2/3 of the time on earnings estimates.
Well, let's just say smarts and wisdom never go out of date, all right? I want to go to a video question from Louise. I think we have it here.
Hi, Charles. It's Louise from Indiana. I have a couple questions. One is I wanted to build passive income using stocks that pay monthly dividends. Also, I would like to invest in I-bonds and wondering if that would be a short-term or a long-term since they are paying a high rate of return right now.
All right, we hit dividends hard, so let me go to you, Phil, on I-bonds. Everyone's asking about them. I think they're amazing. I think there's one drawback. It's not a drawback, but the limit amount that you can buy.
Yeah, you can only buy 10,000 bucks. And there's limitations around how long
Can you
you
explain
hold.
to the audience who may not have heard of them what it's all about?
So basically, you're lending the federal government money in an investment that's priced the rate of inflation, and because of the way they were built, they're paying an excessive dividend right now because of the high price of inflation. So you can spend $10,000, go to the federal government, and they'll give you a 10% dividend, well, 9+ right now. And they can have a duration, I believe, as much as 3 years up to 5 years, if I'm not mistaken. In some cases, even 10 years. So you look at those bonds, and you say, wow, this is a chance for me to commit some capital. But to your point, it's a limited amount. You can only do $10,000. I think it's a great way for her to supplement her income. But she touched on something. I think if you're in a dividend portfolio, you could take your dividends out and use them as income. Don't affect your principal, so you're getting some income from your portfolio. Fund the supplement with an I-bond. It's just not a lot of money, and then you're getting an additional supplement to income at a time of high inflation.
All right, you want to add something to that?
No, I agree. I think you're very smart.
Oh, well, I appreciate that. I'm following someone who's great on TV all the
Phil,
time.
meet Nancy, meet Phil.
We've never done this in person.
Let's give them a round of applause, folks. They're absolutely phenomenal. Brilliant, brilliant folks. All right, so we're going to, of course, stay on the markets where they go from here. And really, largely, near term is going to depend on the Federal Reserve. I know everyone's groaning when they hear that. Unfortunately, that's the question. A lot of people are sending in questions about Powell & Company. In fact, we're going to start off with one right now from Frank. Frank, he emails actually his question that says, How high will interest rates rise? You remember that old commercial with the owl and the lollipop? How many licks to the center of a Tootsie Roll? I think you get the answer to that before we get to the answer to this, although I couldn't have gotten two better people to help us with this. Really, when I say brilliant, I mean brilliant. Welcome in our two next guests, two superstars on the Federal Reserve, also economic thinking, Quill Intelligence CEO, Chief Strategist, Danielle DiMartino Booth, along with Bianco Research President, Phil Bianco. Danielle, did you hear the question?
I heard the question.
All right. You want to tell me how many licks to the center of a lollipop or answer the question?
I actually think that we're going to see a three-handle before this is all over, believe it or not. A lot of market participants right now are betting that Jay Powell's going to get scared and that he's going to hit the panic button and that he's going to stop. I think he really wants to the extent that he can, he wants to be as tough as Paul Volcker was on inflation. And I actually think that unlike prior midterm cycles or any political cycle, I think he's going to press forward into the midterms to not appear as if he's trying to curry favor with one party or another,
right,
which is actually not how the Federal Reserve usually operates.
Right. Right. Phil, you've been writing, though, Jim, that you think he has no choice but to go strong, go hard on this.
Yeah, I agree with Danielle. He's got a credibility problem. They used the word transitory last year. That turned out to be terribly wrong. They have to rein in inflation. The only tool they have is to raise interest rates. Now, I agree with you that we could see 3%, maybe even the high threes within about 6 months. But on longer-term interest rates, they might be closer to peaking out. So we'll get this situation where we have short rates higher than long rates, which is an inverted yield curve, which unfortunately...
So that changes the conversation from inflation to recession.
Right,
exactly.
Because an inverted yield curve has a very good track record at predicting a recession. Yep. We're there with some of the yield curves, but we might be there with...
There's the one they like is what, the 5 and 30 or something, some odd combination?
Three month.
Right,
yeah.
Okay.
And that should be inverted by tomorrow.
Okay, at this rate.
Next rate hike.
Well, let's get to some questions from the audience, okay? First one's sent to us by Danielle. If interest rates usually have to exceed the rate of inflation, how high do you see interest rates going? And do you believe that the Fed will be able to orchestrate a soft landing? I guess no one sees it getting that high. I mean, you know, it's almost an impossibility.
It is at this juncture, and I would venture to say that any notion of a soft landing is being refuted every day by one company after another announcing layoffs, that they'd overhired and now they're not seeing adequate demand, whether it's Walmart or AT&T or Verizon. General Electric today came and said, you know what, we've got $1 billion less in cash flow than we had expected. So I think a soft landing is kind of fantastical at this point.
But what about this, Jim? What about the notion that the markets are actually doing the work for the Fed? And the reason I say that, we got new home sales in, folks. I don't know if you were going to sell a new home or you're looking to buy one. If you're looking to buy one, it was good news. In 1 month, down $40,000. 1 month, the median price. That's kind of crazy. I mean, we knew it was exponential. We knew it would blow up like a Roman candle, but golly.
Yeah, the market's doing the work of the Fed for the Fed. That's a nice way of saying that it's making everybody miserable because it's making the economy go in reverse. The whole idea was we were never supposed to have the markets do that in the first place. But, you know, as far as interest rates go, to the original question, yeah, inflation's 9%. We don't need them to go to 9%. There is a broad belief that inflation will come down. Is it going to go all the way to 2? Probably not. Right. But it might go to 3 or 4, which means that that's where interest rates will probably settle.
Let me ask you something philosophical. People who are not necessarily in the markets, right? You're sitting at home last year, and all of a sudden, every time you open up the mailbox, you got a check. Right? It's like, okay, you took it, you cashed it, you went to the mall, right? I mean, what the hell are you going to do? That's why they sent it to you. Right. And you're having a great time. Your neighbors are having a great time. And then you hear about a year later that the government, between the federal government and the Federal Reserve, deliberately want to hurt you, deliberately want to make your house worth less, deliberately want fewer people to have a job. Yeah. Is there something wrong with the system that does that to the American public?
Look, there was something very wrong with all of the people who were surprised at the money that they didn't necessarily need. I can't tell you how many American families were like, I feel like we should be giving money to the people who really need it. I don't need this child tax credit in cash. And then they spent it. And in many ways they did. But now we're seeing auto repossessions go up. We're seeing loads of RV repossessions. Boats will be next. Banks don't know where to put them. But the backlash is, though, that this created the inflation that is the most regressive of all taxes, because The federal government authorized the spending, and the Federal Reserve monetized every last penny of it, that's a huge no. Never monetize the national debt. They tell you that on the first day when you're inside the Federal Reserve. Trust me, I remember. And yet we did a lot of it.
Let's get some more questions. I'm going to go to Bill, who sent us a video question.
Hi, Charles. Bill Bodner from Red Bank, New Jersey. Why does the Fed talk about raising rates expeditiously when energy, food, and daily essential costs make up a bulk of that inflation, which the Fed can't fix with higher rates? And I guess a secondary question would be, is core inflation moving lower because that headline energy-based inflation remains stubbornly high? Thanks for taking my question. Have a great day.
Fantastic questions. What do you think?
Yeah, as far as the second half of the question about core inflation moving lower, there is some argument to be made that what you're trying to do with core inflation is remove energy prices, remove food prices, but you can never remove them from everything, transportation costs and everything else, that might be impacting those prices. As far as the first part of the question, the Wall Street acronym for that is, well, the Fed can't print ships, the Fed can't print oil, so what are they trying to do? I'll just point out to everybody, the U.S. has the highest inflation rate in the developed world. Well, Portugal just recently took us out, but we've got a very high inflation rate. Well, the rest of the world has a supply chain problem. The rest of the world has a Ukraine war problem. The rest of the world has high energy prices. Why are we number one? It gets back to what we were talking about a minute ago. We mailed out more money than anybody else, and that's why we have higher inflation. The Fed can do something about that. So raising rates to try and rein in that excess demand, I think, is where they're going.
Again, it's such a tough thing to know that, hey, I just did my part as an American, you know. I helped spend the money that you gave me. I thought there were no strings attached. Boy, did these strings hurt. All right, let's go to Michael in the audience with a question. Michael. Does anyone? All right, so we'll get back then. Okay, I got an email question sent to us from Brian. He says that the idea that Jay Powell can fix the economy with only monetary tools seems like a pipe dream. Remember Paul Volcker and Ronald Reagan on the fiscal side doing all he could for the business community. It's a dumbbell with monetary on one side, fiscal policy on the other. Jay Powell cannot do it with fiscal components alone. Why is there so little conversation about this? Danielle, I mean, ironically, you know, I mean, if the White House had their way, we'd be printing more money. I mean, if it wasn't for Senator Joe Manchin, if Build Back Better had gone through with the more, I don't know how much it was, I forgot the price tag, but how much exponentially would inflation be? I mean, it would be even more.
We would be staring down the barrel of double-digit inflation and double-digit inflation that continued to rise.
Right.
And the same type of speculation that has fed people who buy homes to rent out, speculation everywhere, that would have continued and actually increased because, again, the Fed is the other hand. They're monetizing all of this. And I think that Jay Powell, and I'm rarely defend this man, you know that, Charles, but I think that Jay Powell is actually relieved right now that he's not being pressed upon to print more money, that right now fiscal policy is on hold so that he can try and get this inflation under control.
He might not be pressed to print more money, and I agree with that, but he was pressed by the president last month when he was at the Oval Office, and he pointed at him and says, the president said, the job of bringing inflation down is to the Federal Reserve. So, Jay, go make it go away. So you could argue the question was right. Does he have the tools that he can do something about it? Maybe, maybe not. But he can't say, I can't do anything about it. The president just ordered him to.
Right.
Well, yeah, but Jay cannot create a pipeline, though.
And if you're paying attention, on Sunday, Elizabeth Warren wrote an op-ed in the Journal essentially saying she's going to blame Jay Powell when everyone has to feel this pain that he's been ordered to inflict upon us.
Oh, bless
We
her
got time
heart.
to squeeze in one more. It's from Bob, who sent us this question. Which type of inflation cannot be put down by the Fed? Won't we have stagflation no matter what Powell does because we need more energy? What do you think about that? Let me start with you, Jim. Stagflation, is that still a possibility? I almost felt like we should have had bingo cards, right? It's been inflation, deflation, disinflation, stagflation. You know, already in the show, someone would have been a bingo. Would I win? $10.
Stagflation, unfortunately, is a reality. It's not even a possibility. When you've got 9% inflation now, which is the highest in 40 years, and if you believe a lot of Wall Street, and there's no reason not to at this point, Thursday's GDP will probably be the second consecutive negative quarter, and you've already got the White House trying to spin that as not being a recession.
Right.
That's stagflation. Now, the good news about stagflation, the bad news is nobody wants it. The good news is historically it doesn't last very long. Maybe a quarter or two or several months. It doesn't go
Didn't
on
it last
for
a whole
years.
decade in the 70s? Didn't
Well,
it go from 65 to 82?
It came and it went.
I hear all the
It
old
came
folks. Yeah, I remember that. Yeah, I was there for that. Golly, it was a hell of a time. Pushed my Volkswagen up the block. I was in a gas line for 7 days. I remember that. Come on now, Jim.
There was still job creation going on at the time. We were still creating jobs as a country. We were still growing as a country over that decade, even though it was punctuated with stagflation.
We have to leave it there. Danielle, Jim, you are two of the very best. We were lucky to have you. Thank you very much, folks. We got to give them a hand. Appreciate it.